Hey guys, Sean here at K2 Trades. Today I'm going to be going over margin trading. So what is margin trading? Margin trading allows you as a trader to enter large positions with a small amount of capital. This allows you to open a large trade in the Forex market, then allows you to exit the trade after a small movement in price in your direction to close out with massive profits. However, since most new traders do not know what they are doing, this is not usually what happens. Here's an example when margin trading goes bad. When you enter a position larger than your account balance and price goes in the opposite direction, odds are your position automatically closed with a huge loss instantly. When this happens, you've experienced a margin call. When you get margin called out, your broker closes out your position automatically to prevent your loss from exceeding your account equity. This is why risk management is key. That way you'll never experience a margin call and will never blow your account. Margin applies differently from broker to broker, so you will need to understand how your margin account works specifically. Here is the main difference with margin trading on non-regulated and regulated brokers. On a non-regulated broker like Hugo's Way, these brokers allow you to use extreme leverage like 1 to 500, which allow you to risk your entire account all in one trade. On a regulated broker like FOREX.com, which we recommend, these brokers only allow very minimal leverage like 1 to 20, which will only allow you to risk a very small percentage of your account per active trade, making it virtually impossible for you to blow your account. As we always advise, risk management is the #1 factor in becoming a long-term, consistently profitable trader. Remember that trading should not be viewed as a get-rich-quick scheme. If you do, you'll end up like most new traders, taking on too much risk and blowing their account very quickly. Here's an example of how a margin call occurs. When your margin exceeds your account balance, then your broker will red card your position and automatically close your position for a loss in order to protect you and themselves from losing more than your account has at that time. When using a regulated broker, they will generally only allow your margin to exceed 20 to 30% max. If you're using a non-regulated broker, they will allow your margin to exceed your entire account. Understanding margin. Margin is very complicated to understand for many, and although it is important for you to understand how margin works, if you exercise proper risk management, then you will not have to worry about margin very much. Since margin will vary from your own specific account broker type, everyone's explanation for margin will be different. For now, we recommend that you always exercise proper risk management so margin will never be an issue. If you have any specific questions regarding margin, feel free to ask so we can advise. In the next module, we're going to be going over recommended broker TradingView and technical analysis.